physical gold. It'll protect you against inflation and some very crazy times that can happen ahead of us here with the markets and such. You have an economy right now, it's not doing that well, even as you're reporting it. Inflation is a big concern for people, and it's worse than has been being reported. And I think most people see that.
Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Today we're joined by John Williams, the founder of Shadow Government Statistics, also known as Shadow Stats. A consulting economist with decades of experience, John is best known for his work challenging official government data, particularly inflation, unemployment, and GDP figures. His deep dives into historical methodologies and economic reality have earned him a devoted following among those skeptical of mainstream narratives. Today, we'll explore his insights into America's true economic health, inflation manipulation, and what's really behind the numbers. John, thank you for coming on the show.
Thank you for having me, Steve.
Yes, the pleasure's all on this side of the table, sir. Let's start out kind of big picture. And what is your macro view of the world economy and financial markets today?
Well, the U.S. economy is the dominant one, and it's the one I follow the most closely. And it's the one that gets heavily manipulated by government statisticians. Very simply, I think the U.S. economy is already in a recession and see a deepening recession in the year ahead with higher inflation. And that will tend to have negative impact both on global economic activity and inflation.
Okay, so basically, you believe that we're already in a recession, and a lot of that is due to the higher inflation that we've seen recently?
Well, that's part of it. If you look at the United States, which is the country I concentrate on, I mean, you have all sorts of political pressures going back and forth globally, but we do have the dominant economy. What you have to understand with the U.S. economic statistics is that they have been happily massaged over time, so that what you see in the headline reporting of everything ranging from the total economic activity is seen in gross national or gross domestic product to headline inflation, the consumer price index that gives you an idea as to how prices are rising. Those factors also have parallels on a global basis, but basically the U.S. economy is comes close to half of that in terms of aggregate impact. So I think that if you concentrate, whatever you see happening in the U.S. economy is generally going to lead global activity.
Okay, so because we're the world reserve currency, a lot of other countries have, used the U.S. dollar through treasuries and bonds. Because we're kind of the backbone, I guess, the foundation, what happens here is going to have some spillover effects into other economies.
It will. And if you're seeing weaker consumption here, which we are seeing in terms of actual numbers, that will tend to reduce the imports or the exports of other countries and part of their economic strength. So that's you don't have the U.S. go into a recession without having global impact on something of a parallel basis.
Okay, okay. All right. Now, you started looking into, you call them shadow government statistics. You started looking into these government statistics back in the 70s and 80s. What led you to start doing that? How did this come about? Maybe give us a bit of your backstory of how you came into this work.
Well, my father imported the steel chainsaw from West Germany, or what was then West Germany, and I was going to go into the business with him, which I did, and later the businesses were sold off, and things evolved somewhat differently than expected. But I went to Dartmouth College, majored in economics, got into to econometric modeling, where you can use statistics to try and work out relationships between different factors, where, let's say, income might affect the gross domestic product, or how the economy, the gross domestic product, at least the GDP, broad economic measure of the U.S., if that's growing or not growing, how that's related to employment and unemployment. I got into specifically the U.S. numbers, but also looked at the global numbers and how they were reported and put together. and tried to develop models of them. And what I found was that we were not exactly getting consistent and honest reporting. The biggest factor, and it actually has major impact on the world, given again the scope of the U.S. economy, was that back in the 1980s we had a something of a shock in the consumer price index, where it was getting higher than expected, and the government looked at ways to try and bring down the headline inflation. And what they made was a change to the way the consumer price index was measured. And if you have any accounting background, you don't do things like that. You try to put everything on a consistent basis so numbers are comparable.
Mhm.
The government didn't have to go by that with its reporting of the CPI, and what they did is they changed one of the components, which was the homeowner's equivalent rent, or what became the homeowner's equivalent rent. One of the major cost components in the Bureau of Labor Statistics CPI measure, the inflation measure, was the cost of owning a home. The cost of owning a home went up. That had its parallel impact on and a fairly good impact. Say good, I'm saying proportionate impact on the CPI. So the first change that they made, and this was done deliberately to reduce the headline inflation, was instead of reporting the cost of owning a home, they changed that to the concept of the homeowner's equivalent rent. What the government would calculate that the average person would rent his own house to himself for, and then how much he'd increase the rent on himself each year. That was the way they redefined the cost of owning a home. And the effect of that was that it reduced the headline consumer price index, the total aggregate CPI, by 1.5 percentage point year over year, which was a significant decline. This process went on, and Catherine Abraham, she gave a nice explanation of what happened. And if you don't mind my reading something here, I did talk with people, and I have here a quote from her. Again, she was the head of the Bureau of Labor Statistics,
Yeah.
the commissioner. She explained that back in the early winter of 1995. Now, keep in mind that the actual manipulations here started back in the early 80s, but this is where it gets very much into the public. She said back in the early winter of 1995, Federal Reserve Board Chairman Alan Greenspan testified before the Congress. He thought the CPI substantially overstated the growth in the cost of living. Again, this looking for self-interest in terms of what these people have to deal with policy. His testimony generated a considerable amount of discussion. Soon afterwards, Speaker of the House Newt Gingrich at a town meeting in Kennesaw, Georgia, was asked about the CPI and responded by saying, quote, "We have a handful of bureaucrats who all professional economists who agree they have an error in their calculations. That's nonsense. That nobody, no real economists were claiming an error." He says, quote, "If they can't get it right in the next 30 days or so, we zero them out and we transfer the responsibility to either the Federal Reserve or the Treasury and get them to get it right." And the way Catherine Abraham explained it, she's the Clinton Bureau of Labor Statistics commissioner. She remembers sitting in Republican House Speaker Newt Gingrich's office where she says, yeah, quote, "He said to me, if you could see your way clear to do these things," this is to reduce the CPI, "we might have more money for the BLS programs."
Wow.
They did, BLS did change things, and they lowered the CPI, and everything else followed through. So what they did was the part of this was, and again, they have to consider your cost of living. What does it cost me? What is my cost of living now? How much does it cost me to live how I want to do it today? And against how I did that last year, assuming that you have the same lifestyle. Gingrich, actually a Greenspan, he talked optimistically about the financial benefits of a more accurate index. He said, quotes, "Economists believe one of the most important CPI upside biases is when consumers shift their buying patterns in response to changing prices, substituting one product for another. The price on an item like steak gets too expensive, consumers may switch to hamburgers. Well, that's the real world. I mean, that's what people had to do, but that's not measuring a consistent CPI. If you
Yeah.
change the CPI to reflect steaks as hamburgers, you're not putting out a consistent consumer price index.
Yeah.
And this the nonsense that went on with that just got worse and worse. But every time they've made a change to the CPI, they've documented it and they've estimated its impact on the consumer price index. And using their numbers, I followed it over time. And whenever they made a change, and they said, and this is here we're reducing we're knocking half a percentage point off the consumer price index as it would otherwise be calculated, or knocking off 1% here. I've made note of that. And what I did was, because I took personal offense at what they were doing and what they were representing here, because they were effectively stealing from the American people by redefining away the inflation. So I just tracked their inflation changes and said if they hadn't done this, here's where the CPI would be today. And that's right now, you look at the headline inflation of 2.31% year to year. That was the latest. Had they not made any of those changes that I just discussed, and they did quantified each time they made a change, you're saying this is going to knock this much off the CPI. Not one of them increased the CPI. The headline CPI today would be 10.46%.
Oh, wow.
So that the aggregate numbers here, excuse me, effectively over time, the changes to the CPI have knocked 8 percentage points off of the consumer price index as it used to be looked at and calculated in terms of adjusting cost of living adjustments. And guess who got a short shift on that? That's the average guy whose, let's say, Social Security payments were adjusted for the CPI. The year to year change here would be 8 percentage points higher than being currently done. As far as I'm concerned, it's criminal, but that's just my opinion.
Well,
In any event,
yeah, you're in a group of you're among
yeah,
friends here. We also think it's criminal. So basically, this started back in the 1980s, where they decided that hey, it would be in our best interest as politicians if we could kind of redefine some of these. And it started with owner's equivalent rent, essentially asking homeowners what they would rent their own house to themselves for, which sounds insane when you word it. But after that, then Gingrich came along, and I think he was the Speaker of the House in the late 90s, and he basically told the BLS, hey, if you can kind of get these numbers going the way we want to go, we can probably find some extra money for you. So there was incentive for one hand to wash the other on that one, and so it
yes,
happened. And over time, this has had a compounding effect where we can see that the reported CPI right now is 2.3%. But if you use their data back from 1980 and continued it out today, the number you're arriving at is 10.4% inflation.
that's correct.
Okay. Huh.
And that's why if you're on Social Security and things you're not making quite the ends meet as you thought you would, there's a reason for that. Because your cost of living adjustments have not been in line with the actual CPI, but rather the headline gimmick one, which is again it's right now you're short 8 percentage points.
Yeah. Yeah. Okay. You mentioned substitution. Can you go into how they kind of grease the numbers here? There's substitution, hedonic index, and weighting. Can you kind of give us an overview of that?
Well, the in terms of the hedonic weighting, and that has had some major impact. They'll look at a price increase if it's due to quality improvements.
So basically, like hedonic index would be like if my phone has improved, and so they say that well, because your phone is so much better, we're going to say that even though it costs $1,000, it actually doesn't because it does so much more now than it did 10 years
Yeah,
ago. Would that be an example?
exactly. That's a very, very good example. It's getting the same basic product for the actual cost of living, the actual pricing that's charged for things. That's what you're out of pocket. I mean, the fact that they have maybe your telephone services has improved over time, that's not a reason for the government to reduce your CPI adjustment unless your cost of telephone service has gone down.
Okay. And substitution, you alluded to that. They're not using T-bone steaks anymore. They'll use ground beef or chicken.
Right.
So that's a way that, chicken is less than beef. So they somehow justify it that it's got the same grams of protein. So they can.
Well, you're still eating and staying alive. If you're eating and staying alive, they count that as your cost of eating food. It's nonsense. Again, every change that they've made here, they've documented and estimated its impact on the CPI. And again, if you look at that, the over aggregate change and all these different changes, a lot of them tied to the areas we're talking about now, aggregate to 8% or so since the 1980s. And the average person doesn't understand that, but they know they're not living as well as they were generally back in the 1980s on the same income.
Yeah. Yeah.
And that affects consumer sentiment and other factors. In fact, I know we're going to be getting into the economy in a bit, but there's one measure that I find of exceptionally good quality, published by the University of Michigan. That's a consumer sentiment measure. They've been reporting it consistently for decades here. And what shocks some people is that where the headline economy has recovered, according to the GDP, which is probably the best measure around in terms of actual economic activity and inflation activity, this sentiment measure has never recovered the pandemic recession from the pandemic recession. And the National Bureau of Economic Research, which is something of an independent organization that estimates the total value of the economy, the gross domestic product, and how it's doing, was puzzled because normally when you have an economic rebound, the consumer sentiment rebounds as well. It rebounds to pre-recession levels or whatever the measures here. And they couldn't figure out why that had not happened. And it still has not happened. It's still 30% below where it was coming into the pandemic. And again, the National Bureau of Economic Research, they're the big analysts of the whole system and reasonably independent. They came to the conclusion that what happened was these changes that the government made to the CPI had thrown off consumer sentiment, that these things were never accounted for in the fact that inflation is actually higher than it's being reported is dampening a consumer sentiment. And that's why it hasn't recovered pre-pandemic levels. So we're beginning to see some evidence from independent measures here that there's something screwy in the government GDP numbers, if you'll pardon the expression. And that's the headline manipulations here on the CPI have been a major factor.
Okay, I'll throw up the Michigan consumer sentiment, and you can see on the chart that, yeah, around when is that? Around the pandemic, it fell from basically 100 down to 70, and right now we're at 52, which it still hasn't gone above that level. That's impressive. Okay.
It has not recovered.
Yeah, yeah, it has not recovered. Okay, so that hit inflation pretty well, and also weight. So we've got substitution, we got hedonic adjustments, and weight. Tell us about weighting. Is it like if housing goes up too much one month, they can say, well, this month we'll say instead of 30% of consumers' budget going to housing, we'll make it 27. And that might be able to soften the numbers a bit. Can you describe weighting?
That's the problem is it's not consistent. And it should be, if weight things consistently, then at least you're reflecting closer to reality for not consumer expectations, but their actual experience.
Yeah. Okay. So substitution, hedonic index, weighting. Let's talk about unemployment. What's the government reporting right now on unemployment, and what are you seeing?
Well, the unemployment, it just gets better and better recently. It's
Okay.
in terms of the latest unemployment numbers, which are for the month of April. You have the government itself publishes a couple of estimates. The headline numbers is what they call U3, and that's a measure of the number of people who say they're unemployed, currently unemployed, as a percentage of what they determine to be the labor force. That's, I think I said 4.3% is 4.2%. They have a broader number called U6, which includes people who are discouraged workers and have been unemployed for a longer time, looking for jobs, can't find a job. That's up around 7.8%. That's the broadest measure that they put out.
Okay.
The problem is if you're a discouraged worker, the concept of discouraged worker is you're not actively looking for work. To be counted as unemployed, you have to be looking for work. The U3 and the U6 are largely based on that. But if you stop looking for work because there are no jobs to be had, you then become a discouraged worker. And as long as you're looking, and they'll count you in the headline unemployment, if you go to the discouraged worker category, they count you for a year. And after that, you're no longer counted. What I do is I look at the discouraged worker category for those people who've been out of jobs for over a year and can't find work, but would still like to work. That's still, I got estimates on that, that it tells you a little bit as to how the current employment situation looks. Where the headline U3, that's the number that's reported each month, 4.2%. Their U point, what they call their U6, which is a broader measure, includes some of the people who are, or want a job but can't get it, and that's up to 7.8%. And the shadow stats estimate, looking for the people who'd like to work but are no longer being counted by the government, I'm up at 27.5%, which
Oh,
is
wow.
a significant problem. I tell you, there are a lot of people out there that would like to work, but they can't find a job. And that's a crisis that the government is not addressing.
Okay, let me make sure I understand this. Okay, so U3 is what we all see in the headline, and that's
Yeah,
4.2%.
that's
U
4.2%. You have to be actively looking for work.
Yeah. Okay.
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 The U6 includes some people they haven't given up looking for work entirely, but they can't find a job because there are no jobs to be had.
Okay.
That's their conclusion. And so they get into the area where they stop looking for work because they're convinced there are no jobs to be had, but they want a job. And that's good for a year. But that's it. That moves into the U6 unemployment measure. And then if you've been unemployed for a year and you still can't find a job because there are no jobs to be had, they don't count you anymore. And so I've estimated the population of the unemployed who really would like to work, but they just can't find a job. They're in an area where the economy is depressed, whatever. And counting those, I get up to a total of 27.5% as to my headline unemployment rate. And that's something that's built up over time where the economy's been shifting and people have been permanently losing jobs.
Yeah. Okay. So the headline number is 4.2. U6 is basically the ones that want a job but can't find one. So that's 12 months or less, and that's 7.8.
Yeah, that's the government's broadest measure.
Yeah. But what you're counting is essentially by the government's calculations, if you haven't had a job in over a year, you're pretty much removed from the equation and they don't count you anymore. But
That's right.
that's kind of ridiculous because they're still unemployed. And so you do count them. And that number is 27.5%, which meaning somewhere between 1 out of 4 and 1 out of 3 people that could physically be working are not,
And people would like a job but haven't been able to find one.
but haven't been able to find one. Wow. So now that 27.5% is essentially on the government dole, where the rest of the population that is working is essentially paying for them through welfare and other government subsidies.
Yeah, they no longer collect unemployment insurance.
Wow. Okay. That's got recession written all over it.
Yep.
All right. Let's go into GDP. So go ahead and just give us the kindergarten definition of GDP.
Well, gross domestic product.
Mhm.
It's a total, supposed to be a measure of the total economy, all business activity, gross domestic production. It's a very heavily gimmicked number. A lot of, I mean, you get all sorts of assumptions get built into it.
Okay.
Headline gross domestic product. It's the broadest measure of U.S. economic activity put out quarterly by the federal government. It includes all areas of the economy. And it's the GDP that is used as the formal indicator of whether you're in a recession or an economic boom. You get to two quarter-to-quarter contractions in GDP. That's usually defined as a recession. And the GDP here, net of inflation, the growth there is real growth net of inflation. right now, if you look at the headline numbers, the latest numbers, it's gross domestic product in the first quarter of 2025 was positive, as headline, up 3.5 percentage points. That's nonsense. I could use a more explicative term on it. But the GDP number that's put together and put out is very heavily gimmicked and oftentimes does not have much relationship to underlying economic data. Consider, it gave you the first quarter GDP. The fourth quarter of last year was also up 3.5%.
Okay.
And in terms of putting all the numbers together for the first quarter on underlying statistics, I have them in place for the fourth quarter, which gives you a pretty good indication as to how the GDP number is. Because if you look at retail sales, for example, which is it's a reasonably good quality number. Normally it is deflated by inflation. So you look at the real retail sales and you see the increase in sales or decrease in sales. It's not due to price changes, it's due to actual physical volume. For purposes of eliminating other arguments, I've deflated the retail sales numbers by the headline consumer price index, which is the way you would normally do it.
Okay.
And if you look at it last year, it didn't grow year over year. Fourth quarter, no growth year over year. You see basically the same thing in industrial production, which is published by the Federal Reserve. The key monthly numbers, look at housing statistics. That's an area that gets heavily bloated because of the way they count the housing statistics. That was also down in the fourth quarter year over year. So if you have broad segments of the economy that if you look at them on a monthly basis in the quarter are down year over year, and then these are, again, adjusted for inflation, how can the broad GDP be up 3.5% year over year? It was up fourth quarter as well. It's nonsense. It's nothing but political hype. I would give it a 0 in terms of meaningful quality.
Okay, so you're saying basically the inputs that they use to calculate the GDP are bad. So how is it possible that the GDP is showing growth? That's essentially fantasy.
Yeah, it's a heavily rigged with definitions of some of the subcomponents. It's a good number for pre-elections. And guess what? You can look at the GDP's been manipulated over time. It doesn't have much relationship to underlying reality that I can see. We just came through a presidential election, and they're my favorites because they give you some insight into how the people are really doing in the economy. And what I found over time, if you look at actual economic activity, if the economy's doing well, the incumbent party usually gets reelected. If the economy's down and people are suffering, usually they vote to change parties and you get the other party in. You look at what happened to President Trump and coming in at the end of his first term, he was hit with the pandemic, the worst downturn we've had in some time, and it killed his chances of reelection. And you've had the Biden administration. And the Biden administration, they did some clever things at the time of the last election where they depleted the petroleum reserve, the strategic petroleum reserve, to boost gasoline supply, to bring down prices of gasoline, which are that's a big component of the CPI, and that would bring down the inflation and helped, and they did okay. But the coming into the this presidential race, that is, you got a clear reading there that people were not satisfied with what was happening in the economy. There were no gimmicks with gasoline prices, and the underlying economic activity was one that was down. And if you look at it regularly on that basis over time, if the economy is down, it's very difficult for the incumbent party to win re-election. Usually, the challenger wins.
Yeah. Okay.
So we had what we saw in the latest election confirmed what I was seeing in other numbers, and that is that we're already heading into a recession, an actual recession. People know you can play with the numbers and say, hey, things are booming, but the average guy knows what he's experiencing, and he'll vote his pocketbook. And despite the happier news on the economy out of the prior administration, did not lead into a re-election of the same party. And that's because the underlying populace, the underlying economy was not as advertised. Election before, that was there they actually improved the numbers, and that helped. That was a clever thing they did. Of course, They depleted the petroleum reserve, which is another problem and issue that needs to be addressed. But fair bet, you look at economic results, broad economic results, that'll give you a pretty good sense as to whether the economy's booming along or in trouble. And that's a signal that we've had. And now you have the Mr. Trump's administration in, and he's been doing making a lot of unusual changes to tariffs and government structure and such, none of which that I can see is going to do much to boost at least short-term economic activity. And he has a slowing economy that got him reelected. So I think we're seeing weaker numbers now. I think we have a recession in hand, probably going to get deeper by the end of the year. And again, this gets you back to consumer sentiment. It's a good indicator of where things are, and consumer sentiment has not recovered its levels of pre-pandemic. Still hasn't. This is a type of environment that the incumbent party needs to get turned around if they want to have a good election going forward. It's an unsettled circumstance. A lot of changes are being made, and we'll see how the changes work out and how volatile the effect is on the consumer. That's sort of up in the air right now. But it's if you don't see an economic rebound, an actual economic rebound, you're likely to see a shift in parties again.
Okay. Okay. So basically, the GDP, the gross domestic product for the fourth quarter of 2024 they're showing increase of 3.5% in growth. And then they did the same thing for the first quarter of 2025, 3.5%. What are your numbers showing?
Well, what I'm looking at, I'll contend we're in a contraction and a recession, but giving them the benefit of the doubt where you have year-to-year change flat in key numbers such as the real retail sales, and that's adjusted for the CPI inflation, not my inflation, industrial production and the housing numbers. The subcomponents, the monthly components of the economy, basically are still flat year over year. They may be picking up a little bit. This first quarter is real strange because we're seeing all these shifts internally in the domestic economy. It's going to take another quarter or two before it settles down into what's going to be a consistent pattern. But based on where we were in the fourth quarter, there was no growth year over year in the economy. That accounted for why there was a shift in the political spectrum.
Yeah.
But what I'm seeing with the underlying statistics, you may be seeing a little bit of inching up year over year on some of them, but we're still in a flat to negative circumstance. Here we are into the second quarter. So it's going to be basically flat to small growth in the underlying numbers for the first and second quarters. As I see it, that'll probably translate into a much bigger GDP number, the way they play the GDP numbers. But from what the standpoint of what the average person sees, the average person doesn't see the GDP. He goes out and he buys things in retail sales. He knows whether or not the houses in his neighborhood are selling. If he's got a job, if he's getting increases in his wages, if he's keeping up with inflation. And where do you see that number? Look at consumer sentiment. University of Michigan, it's the best quality economic statistic out there. It gives you, they're independent. Over time, it's got the best record of underlying real economic activity. This is not consumer confidence. That's a different number, and that's very heavily politicized. But the consumer sentiment, as best I can see, is probably the best widely published monthly economic statistic around that gives you a very fair indication of where the economy and both the economy and inflation stand, because it measures both factors. People know how they're doing in the economy, whether they have a job. They also know how they're doing with inflation, and they're independently surveyed by the University of Michigan, which has put it together in a semblance of modeling that seems to work very well over time. And it does not show an economic recovery post-pandemic.
Okay. Okay. And so essentially your forecast is it's flat to slightly down, possibly slightly up, but nowhere near 3.5%.
No, well, I think it's down. But if you're slightly negative, that counts as a recession. But if you look at in the fourth quarter, if you look at the numbers, the retail sales were down year over year, industrial production down year, housing down. And those are monthly series. They have games that are played with those as well. But usually they're pretty good indicators of what you're going to see in the GDP. And the GDP should have been down given what was there. I think we're seeing continuing gains with the GDP, very heavily politicized, 3.5% growth, not a chance.
Yeah. Okay. And they have a vested interest in doing this, especially around election times,
Yeah,
because you can make yourself look a lot better. We've grown 3.5% than if you show the reality. And
that's right. Absolutely. And that's why they do it. But the point I was making earlier is one of the most significant points I can make is I followed these numbers over time, both the gimmick and the average guy. If you survey him in a poll like consumer sentiment, he'll often parrot, well, let's say not consumer sentiment, but say consumer confidence, which is put out by the Conference Board and is much more politicized. He'll tend to parrot what he hears in the media. The sentiment is seems to come up with a closer measure of underlying reality. And the consumer sentiment has never shown a behavior like this before with its negative readings against the GDP when there's not some kind of a downturn. We're seeing heavily gimmicked numbers. They're going to work themselves out eventually. And you can look at take elections. Again, the incumbent party, if the economy's doing well, the average guy's comfortable with what's happening, the incumbent party will tend to win.
yeah.
If the average guy's not doing well, he's doing worse than he was before, the politics will generally shift to the challenging party. You can read the economy sometimes by how the elections turn out.
Yeah. Okay. Our audience is pretty into precious metals. We have to take the hand we're dealt. What is your advice to the average Joe, the average American?
We have still a serious inflation problem in hand and ahead. The best bet I have for anyone is to own physical gold. It'll protect you against inflation and some very crazy times that can happen ahead of us here with the markets and such. You have an economy right now, it's not doing that well, even as you're reporting it. Inflation is a big concern for people, and it's worse than has been being reported. And I think most people see that. What you get with a headline government statistics is an understatement of the headline inflation and an overstatement of economic activity. And again, if you look at the consumer sentiment numbers, they tend to be more consistent with what I show in both A, the lack of economic growth, and B, stronger inflation.
All right. So basically, you're saying that owning physical gold.
Going ahead, we talked briefly about current inflation. Two major problems there. One is the Fed, and the other is the federal deficit. Federal deficit's just ballooning out of control. There's some effort to contain it, but the federal debt is continuing to grow. That helps to pump money into the system and debase the currency. The Federal Reserve is a big problem. And this goes back to the pandemic collapse back in 2020 when the pandemic hit. The pandemic hit, I guess it was in March. Everyone knew at that point it was really going to be bad. What the Fed did in order to stabilize the system was they pumped 30 years of monetary stimulus into the system. 30 years, 30. So the money supply surged. When you look at it, it goes up over 100% at different points as you're looking at it year over year. That's highly inflationary. And the money supply does drive the inflation. And if depending on how it affects the inflation, it does not always drive the economy. It helped to stabilize the economy. They did what they could. But the Fed's biggest problem is it has to keep its owning the Federal Reserve banks from going out of business. I say owning the banking system owns the Federal Reserve, and they have to keep the banking system solvent. So you listen to some of the crazy things the Fed said as the pandemic hit. Oh, we have to raise interest rates to fight the overheating economy because that's surging inflation. The economy is collapsing. It wasn't overheating. They had to raise interest rates to stabilize the banking system. And if you look at systemic liquidity, both as measured in terms of year-over-year change in the money supply, and what I look at is my measure of liquidity is a combination of your basic money supply. And I say basic money supply. That's my number. At the time that the Fed pumped this massive amount of currency into the system, they redefined the money supply so that you couldn't compare it with prior numbers, except for currency and circulation and demand deposits, checking accounts. Everything else was shifted around. So you had a break in the series if you wanted to look at the components. But that's okay with me because your currency and circulation and your demand deposits and checking accounts, that's your basic money supply. That's what people spend. That's what they go and spend money on. And you take that as a percent of the aggregate money supply, that gives you a measure of liquidity. And it's extremely high. Still, I think that's still up around 60%. So that you have what the Fed did was effectively fuel inflation with the money supply. That whatever inflation problems we've seen, and the inflation problems are worse than being reported, as I mentioned. But the underlying reality with the inflation is largely due to the liquidity that the Fed pumped into the system. Again, 30 years worth. And you can see it in the what I call the basic money supply, again, the currency, the checking accounts, as a percent of the total money supply, and as a measure of systemic liquidity. We're looking at multi-decade highs still. So that is a real problem, and it's going to be a major factor driving the inflation. Now, if you listen to the Fed, yeah, though they pumped all this money into the system, and that was back in March of 2024, and then you get to March of 2025, and you look at the money supply, it's up 120% or something like that, and then you get to the April of 2025, it's up year over year 4%. So see, we've been fighting to bring that down. Nonsense. It's only because the year-on-year comparison dropped from what was the initial balloon back in March of 2024, and again with March of 2025 against that. But once you're beyond the year over year against the balloon, yeah, it was up 4% year over year against what you had in the month a year ago. But that excessive liquidity is still sitting in the system. And that's what is the inflation risk here. That liquidity is what's driving the inflation. And to say they had to raise interest rates to contain the inflation, which is the point they did for excusing the rate rise, that was nonsense. They'd already surged the inflation. The Fed is owned by the banks, the banking system. The banks needed higher interest rates. So they raised interest rates for the banks. I don't know why they just couldn't be more straightforward with it, but the Fed did everything it had to do to keep the banking system afloat, and the banking system is still afloat, and the economy is still afloat. So all that's been done is work so far, but we still have a money supply that is up 120% from where it was before the pandemic. Things are not back into balance. There are all sorts of dangers in the system, and they run in the broad direction of much higher inflation than actually is being reported, and a weakening economy. It's the worst of all worlds. And if I were an investor, well, which I am, but what I would look at is holding physical gold, holding it.
Not GLD on the stock
deposit.
market.
Gold will preserve your wealth over time against inflation. It does that consistently. And if you look at what I did when the government started playing around with the CPI, they changed the headline CPI to reduce it. To their purpose in doing that was to reduce cost of living adjustments they had to pay to Social Security recipients to keep the budget deficit down so that they could make their deficit spending more within limits than otherwise. They really were not balancing the system, but they did hit the consumer with that. The money supply here, the headline inflation here, actually is a lot worse than is being reported. And it's been underplayed. And if you use consistent reporting on the inflation, what you'll see is that again, the headline inflation's up around, it's over 8% higher than they're reporting, basically. With that, if you look at that inflation component, you have to keep in mind that the price of gold is a function more often than not of inflation. Inflation's been your best predictor of the gold price over time. Of course, you can have wars and other crises, but if inflation's on the rise, usually gold will be on the rise. So what I did is I've looked at the headline CPI. I've looked at my estimate of the CPI the way it would be reported if they hadn't gimmicked it. And I've looked at the price of gold. And there was a period of time, I think it was back in 1980, where the price of gold was at 100, the CPI was at 100, And I have plotted that over time. The three numbers. One is the level of the price of monthly average of the price of gold, the headline CPI inflation, and then the headline inflation as though the CPI had not been restructured, just calculating it the way that it had been before. And what you'll see is that where the price of gold is going along and then turned upwards almost exponentially, the headline CPI went along with the gold and then sort of flattened out after you pass the mark where they redefined the CPI. But if you use my CPI, which was the old CPI, it's estimating it the best way I can, as though it were the old CPI, that old CPI also soars along with the gold price. So what that tells me is that the people out there have a pretty good sense of the purchasing power of their currency, and the gold is still moving along with the actual inflation, not the hyped one.
Yeah, I'll put up the chart so everyone can follow along here. So basically, the orange line here is the spot price of gold. The dark blue line is your calculation as to what the CPI really should be if they continued using the 1980 statistics. And the light blue line is what the government is reporting now, which is a vast discrepancy from what it actually should
Yeah,
be. Yeah. Okay. Okay.
you
So your
got it.
basic advice is, if people, the average guy going into what you foresee as this high inflationary environment, if you simply buy physical gold, that should maintain your purchasing power over time as this farce continues.
It's the best thing I can come up with. Real estate usually move over time. Eventually it will, but it's not necessarily as liquid as gold if you need the cash or such.
Yeah. Yeah.
But the real estate prices have a ways to catch up here.
Yeah. It's a lot easier to sell a tube of gold coins than it is a house.
Absolutely.
Yeah. Awesome. Well, thank you very much, John. If people want to follow you and your work, how can they do so?
You can either send me an email or give me a telephone call and I'll be happy to set you up. So give me a call, 707-763-5786, or send me an email, johnwilliams@shadowstats.com. Be happy to talk with you, happy to set you up. Subscription runs $175 a year. I'm offering a special 2-year introductory offer where you get a second year free. And if you want to try it for 6 months, that's $89.
Awesome. Well, thank you very much, John. Thank you for coming on the show.
Thank you so much for having me, Steve. Greatly appreciate it.
Yes. And thank you for tuning in. Go to stevebartonmoney.com for more and have a wonderful rest of your day.